The main policy to reduce inflation is monetary policy. Other potential policies could include fiscal policy and supply side policies. But I'd like to start with monetary policy because this is the most widely used. So generally central banks are responsible for controlling inflation, and the main tool that they use is changing interest rates. Now central banks don't change every interest rate in the economy, but they change the base rate, which influences all the interest rates that commercial banks set. Now supposing the central bank was concerned about inflation going above its target, what it can do is increase interest rates. Higher interest rates have the effect of slowing down economic activity. And by slowing down economic activity, this reduces inflationary pressures. So why do higher interest rates have this effect? Well, firstly, higher interest rates will increase the cost of borrowing. So homeowners paying a mortgage will have less disposable income because they have to spend more on their mortgage, and so they will spend less on other items. Also, if businesses is considering to invest, then higher interest rates may deter them because it's more expensive to borrow. And so higher interest rates are really quite significant for reducing consumer spending and investment. Also, higher interest rates will have the effect of increasing the value of the exchange rate. So if the UK increased interest rates compared to other countries, the pound would tend to appreciate because it's then more attractive to save money in UK banks. But if a pound appreciated, how would that affect inflation? Well, it tends to reduce inflation for three reasons. Firstly, and most importantly, that as a pound appreciates, it means that imports will be cheaper. It will be cheaper to import oil and other raw materials, and this will directly reduce prices in the economy and help to reduce inflation. Secondly, with a stronger pound, it's more difficult for exporters. They're less competitive. So export demand will fall, and this will reduce aggregate demand a little bit. And thirdly, if you have a stronger pound, there's greater incentive for firms to cut costs to try to regain competitiveness. Now, an example of higher interest rates, we could look at, say, 1991-92. UK has quite high inflation, and to reduce it, the government increased interest rates. In those days, the government controlled monetary policy, not the central bank. But anyway, interest rates increased quite a lot, and this did cause a big slowdown in the economy. In fact, it caused a recession, and it caused a big fall in house prices. And this is the drawback of monetary policy. It has quite a big effect on reducing economic growth, and especially people with high borrowing. And so the central bank will try to avoid this boom and bust situation, ideally to try to increase interest rates before inflation becomes entrenched and difficult to reduce. Now, if we look at 2022, we have an interesting situation because inflation has surged across the world, especially in the UK and US, to about 9% at the moment. And interest rates are still quite low. And this is because the central banks were hoping, I think, that the inflation would prove less and prove temporary, because the inflation is caused by primarily cost push factors, higher oil prices, the end of COVID lockdowns. And so they were hoping that this inflation would prove temporary, like it did in 2008 and 2012. But unfortunately, inflation has risen quite a bit, and there's now concern that this might change inflation expectations. So, rather belatedly, the central banks in the UK and US have started to increase interest rates, still quite small by historical comparisons. But because consumer spending is still a little weak, especially in the UK, this higher interest rate will definitely slow down the economy and reduce inflationary pressures over time. It is worth saying that monetary policy isn't the perfect solution all the time, especially if you have cost-push inflation, because higher interest rates slows down the economy, but it doesn't necessarily tackle rising oil prices, which are factors beyond our control. So if we do have cost-push inflation, like we do in 2022, then we may look at policies beyond monetary policy. And one thing you can consider, at least for the long term, is supply-side policies to try to increase competitiveness. And this is something the UK tried to some extent in the 80s. In the 70s, we had quite high inflation around the world, and especially in the UK. And some of the blame, fairly or unfairly, was put on trade unions because they had quite a lot of power to bargain for higher wages, and this contributed towards inflation. So when Mrs. Thatcher came into power, she wanted to reduce the power of trade unions and also introduce other supply side policies to help increase competitiveness, help increase productivity, and this in theory should help to keep inflation low. Now, to be honest, it can be quite difficult to evaluate how successful these supply side policies are in tackling inflation, and they don't tackle the immediate need of high inflation but take quite a long time to have an effect. Another policy that is theoretically possible is fiscal policy. If the government were concerned about inflation, they could slow down the economy with higher taxes and lower government spending, and this would have a similar effect to higher interest rates, and it would be effective in reducing inflationary pressures. But as you can imagine, this is rarely used because which government wants to pursue the politically unpopular policies of higher tax just to reduce inflation? In fact, in the UK, there's now pressure for the government to both reduce inflation and cut taxes because of the cost of living crisis. Another policy about reducing inflation is trying to change expectations, because in the 80s, Britain got a reputation for being a boom and bust economy. The government weren't very good at setting interest rates because before an election, there's a bit of a temptation to cut interest rates to have stronger growth and get more support from the voters who see a strong economy. But this led to kind of ups and downs in inflation. So in 1997, the new Labour government decided to make the Bank of England independent, and it gave monetary policy to this central bank with an inflation target. And the argument is that the central bank will be better at avoiding political pressures, and it will have more credibility to keep expectations low. And if people expect low inflation, then every policy will be more successful. It's easier to keep inflation low if people aren't demanding big wage increases and firms aren't trying to increase prices as much as they can. Now, other policies that are possible could involve price controls. So if prices are rising rapidly, you sometimes hear calls to introduce price controls, prevent price increases. And this was tried actually in America in 1971 under Richard Nixon, just before the election. And price controls were actually quite popular. They helped him win the 72 election. And he tried them again in 73. But to be honest, price controls are very hard to actually tackle the underlying cause, because what will happen is if you limit price increases, then firms may simply supply less. And when the price controls were ended, then there was a lot of, you could say, hidden inflation that kind of came to the fore. And so price controls did nothing to stop the much higher inflation in the later 70s. The only time price controls were effective in reducing inflation was during the Second World War. But that's because governments in both the UK and US combined price controls with rationing. So you limit price increases, but also the quantity of goods on the market. And there have been studies saying that American inflation was less in the Second World War because of price controls. But it's not really a practical policy for modern governments in peacetime. How successful are these different policies for controlling inflation? Well, if the government is really determined to reduce inflation, then you can always increase interest rates as high as you want, and it will bring inflation under control. But the problem is at what cost? So in 1981, in both America and the UK, both government and central banks were quite keen to bring high inflation under control. This led to quite a serious recession in the United States and also in the UK. And the UK had high unemployment for quite a long time in the mid-1980s. If we look at the present situation of cost-push inflation in the UK and in the US and also around the world, what are the best policies here? Well, it's quite a difficult balancing act, because if you take the UK, the economy is already struggling. Growth is quite low. And if we increase interest rates too much, then it could definitely push the economy into recession. And if we don't do anything, inflation may become entrenched. Inflation expectations may continue to grow, and the cost-push inflation may lead to a kind of a wage price spiral that we saw back in the 1970s. And then it'd be hard to bring it down in the future. But on the other hand, some of the economists say, well, it's unlikely to get a wage price spiral at the moment because workers have a lot less power than in the 1970s. And also, inflation is still relatively new for the modern generation. Expectations for the next 2 or 3 years are that inflation will come down. So we may not need to have very serious increases in interest rates because that would kind of overreach and push the economy into recession, where it's better just to tolerate a little bit of inflation. 2 other policies that I'll briefly mention for reducing inflation. The first is monetarism, pioneered by Milton Friedman and others. And they believe that the secret to controlling inflation was to control the money supply. And so this involved a combination of interest rates, but also reducing government borrowing and reducing the amount of supply that the government was creating. And if you control the money supply, then this should in theory lead to lower inflation. Now, unfortunately, the monetarist experiment of the early 1980s wasn't particularly successful. The link between the money supply and inflation was not as good as the textbook suggested. So by 1984, monetarism had effectively been abandoned in the UK. Another policy to potentially reduce inflation is to have a fixed exchange rate. And in the late 80s, the UK joined the exchange rate mechanism. And the argument was that if you have to keep your value of the currency fixed against the Deutschmark as it was then there's a much greater incentive to keep inflation low, because if the UK allowed inflation to go above Germany, then there's downward pressure on the pound. But you can't do that in a fixed exchange rate. So in fact, the UK tried very hard to stay in the exchange rate mechanism, but unfortunately they were fighting a losing battle, and to keep the pound high, they had to have very high interest rates, and ultimately the recession was so deep, markets realised the UK couldn't go on with this, and so they had to abandon the exchange rate mechanism, cut interest rates, and actually the economy recovered. So this policy is not really widely used because it's better to target inflation directly rather than indirectly through the exchange rate, which can cause many problems of uncompetitiveness. And this has been a problem for countries in the euro who became uncompetitive, like southern European countries.